Hello and welcome. This is Stocks to Watch on Bloomberg Queen. I am Agam Vakil. This is where we take you through a handful of stocks which are in the news and focus on the back of earnings perhaps, and we'll take them up with our experts. Well, today, stocks that we are going to talk about, right at the top, we have Bharti Airtel, which has come up with its earnings, a TVS Motor Company as well, disappointing set of numbers, some interesting names which have been buzzing off late on the back of the kind of gains that we've seen. Navin Fluorine and GMM Pfaudler as well is something that we will be talking about in this session. Well, to take us through these stocks as well, we are in conversation with Avinash Korakshakar. He is the Director of Research at Profit Mart Securities, who's joining us. Well, before I get across to Avinash, let's talk about the first stock, and that is Bharti Airtel. We've seen earnings come through, and while the top line is largely in line with expectations, it's posted a very, very large loss, and that's to the tune of around nearly 16,000 crores. Its average revenue per user, however, is at around 157 rupees per user, and that is a tad ahead of consensus expectations. So why is it that we're looking at such a big loss? Well, that is because the company has provided about 10,740 odd crores to AGR dues. We know this is an ongoing issue with the courts when it comes to some of these telecom companies. Let's take this up with Avinash. Avinash, good morning and thanks for joining in. How have you rated the earnings for Bharti Airtel? Well, notwithstanding, of course, the AGR dues provision that the company has made.
Yeah, morning, Agam. I think numbers, presented by Bharti Airtel were in line with expectation as far as the revenue and the operating EBITDA is concerned. I think the exceptional loss which has come in, as you rightly mentioned, has been because the company has provided around 10,700 crores for the AGR dues. And in one sense, I think it's a positive development for the company as well as for the stock, considering that the entire AGR dues have now been fully provided for. So I would believe that going forward, as long as ARPUs remain healthy, the management has already sounded that ARPUs are definitely looking quite solid, and in the near term this could possibly see a further incremental rise. So I think operationally the numbers have been pretty good. On the bottom line front, this exceptional loss has put the company's profitability in the red. My sense is the stock has remained pretty lackluster for past few weeks, considering that there have been no new triggers in the pipeline. But overall, I would believe that considering the stability in ARPUs and the kind of data consumption which is on the increase, plus the kind of incremental 4G customers which the company has made, makes us believe that this stock at this level can give a decent risk reward, provided an investor takes a 12 to 18 month view. I think telecom is one sector, Agam, which is going to do well despite the COVID-19 crisis. And our sense is that Bharti is well positioned to take advantage of the work from home trends as well as the increasing data consumption seen of it. So I think it could be a buy on dip, and definitely longer term one should include it in its portfolio.
Sure. Well, that makes a lot of sense out there. But we move on to TVS Motor Company. And this is where we have seen a very large loss, not only on the bottom line, but on an operating basis as well. So if you consider the revenues, firstly, for the first quarter, year on year, that's down 68%. And this is perhaps on expected lines because we were anyways expecting not too much in terms of sales considered because of the lockdown and COVID-19. But the company has reported an EBITDA loss of 48 crores, and because of that, its net loss stands at 139 crores against a profit of 142 crores year on year. Avinash, I'm sure to a certain extent, a lot of these numbers are already priced in, but how long before we start seeing a recovery in the two-wheeler space and perhaps in TVS Motor Company?
My guess is, I think, Agam, clearly, from a longer term perspective, TVS Motors could definitely bounce back. This quarter number should not be taken as a yardstick because, as you are aware, April and May have been lockdown months. There was virtually no sale, no production. So, the company had to face the brunt of most of its fixed costs, being, serviced without any revenue. Overall, I would believe that the operating EBITDA number is definitely a negative, and we could see some softer numbers even for the second quarter. Overall, I would believe that whatever recovery could happen in the two-wheeler sales and for TVS Motors could possibly happen from the third quarter onwards. Hopefully, we could see better numbers, in the third quarter. In the near term, I would believe, with these numbers, the stock may not go anywhere. It could possibly remain, either flat or lackluster. But the markets could definitely be hoping for better numbers from the third quarter onwards. So I think those investors who have the stock should hold on. I would not be surprised that the stock may not fall significantly because these numbers were anticipated earlier, and this is in line with what the market expected. But overall, I think one can just hold on. I think fresh buying could be considered possibly, after the end of the second quarter when some more clarity on the monsoons, on the volume uptake, and obviously on the management commentary gets reflected. So as of now, it's a hold.
All right. Okay. And from there on, let's talk about Navin Fluorine, a very interesting counter. It's actually trading near its life highs. It did go on to its life high very recently over the past 1 or 2 odd weeks. It's seen a lot of momentum this year as well, and it's one of the top performing stocks. But when it comes to the quarterly performance, we've seen a decline of around 14% in its net sales. Its profit, however, has risen to 30%, and we have seen a little bit of an expansion in its operating margins too. Avinash, we've been talking about a lot of chemical companies of late, and Navin Fluorine is also one of them which is doing quite well. It's not reflected in the revenue numbers, but operationally, it's certainly been a strong quarter. What's your view here?
Agam, I think Navin Fluorine is a specialty chemical company which operates in the fluorochemical, specialty chemical segment. And I think there are very few players operating here. So considering the fact that it's a niche player, plus it's got a very strong product profile, I would not be surprised that the markets are definitely looking at possibly FY22 earnings here. Post the Q4 number, the management had hinted that FY21 would be a challenging year, and one comforting factor for the stock is that the company has a very large order book, which it could possibly comfortably, sail through for FY21 and FY22. Margins have always been high for this company, considering that they have a decent amount of pricing power with their customers. Clearly, I think investors who want to take a longer term call on the business should wait for some decline because the stock has rallied significantly despite the COVID-19 scenario. Our sense is that any decline should be used, to accumulate the stock because FY22 could be a lot better, although the second half of FY21 could definitely show signs of recovery. The full impact of the incremental export order book which they've got recently is going to be reflected from FY22 onwards. So I would believe that it's a hold at current levels and definitely a buy on declines.
Well, as you can see on the graph as well, it's taken a little bit of a dip from making life highs recently. But we'll talk about another stock which is near its life highs, and that's GMM Pfaudler from the capital goods space. Again, when it comes to earnings, it's been reasonably stable. We have seen a year-on-year 7% growth, and well, its net profit has also risen 8.5%. There has been a lot of frenzy around GMM Pfaudler because of the fact that it does supply glass lining equipment to a lot of these chemical companies, which have seen traction as well, and which is why we've seen strength in GMM too. Well, the decline in revenues, or rather, there is no decline. The muted revenue hasn't that much of a sticking thing for GMM Pfaudler. Avinash, your view on this one going forward, how do you assess this?
No, I think Agam GMM Pfaudler is also a niche player which operates, in glass reclined reactors and which largely go on the chemical and the pharmaceutical companies side. Our sense is, this quarter has been slightly below expectations, largely because of some supply chain issues from their vendors. That is why revenue has not grown significantly. But if you see the overall EBITDA margin and the profitability growth, I think numbers have been decent in such a challenging time. The management is pretty confident that they have a very large order book which could possibly help them show incremental top line growth for the next 12 to 15 months. And recently, the company announced some takeover of another company. So in this kind of tough scenario also, the management is reinvesting capex in the core business and is looking for opportunities to add to its incremental capacity. So I would believe that yes, this stock has definitely run up significantly, trades at fair to expensive valuations. But I think clearly the business is solid, cash flows are solid, and the incremental benefit is that both chemicals and pharma sectors are going to do well. So I think one should definitely look at the stock from a longer term perspective, but on declines. Currently, I would believe that investors should not worry for this quarter numbers and continue to hold on.
Okay, fair enough. Let's conclude this segment, Avinash, by asking you about an idea that has struck you of late.
I think Agam, from the frontline private banking stocks, we still continue to like ICICI Bank. I think the markets, obviously did not were not favored. Once the results came out, the stock corrected significantly. But our sense is that if one looks at the overall business model, the asset quality, the loan book growth, and the recent news flows that ICICI Bank would be raising a fresh issue of roughly $2 billion, that makes us believe that the balance sheet is going to be extremely solid going forward, and incrementally I believe the second half will be a lot better for ICICI Bank. So I think one should use the weakness, should get into the stock. I would not be surprised that over the next, say, 12 to 15 months, one could comfortably see a 15 to 16% upside here. So it's a buy on decline, and even at the current levels, and should be included in one's portfolio.
Well, we'll be watching out for ICICI Bank. Well, on that note, Avinash Gorakshakar, we'd like to thank you for taking the time out and speaking to us here on Bloomberg Quint. And on that note, it's a
Thank
wrap
you.
on this segment, but there's lots more lined up. Stay tuned to Bloomberg.